Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Thursday, July 16th, 2026. We're Elena and Marcus.
And today, our daily desk data is showing a pretty violent structural realignment happening in the markets right now.
Yeah, we are looking at massive artificial intelligence stocks dropping hard, while these historically boring defensive sectors are just taking off.
Right, and all of this is happening while the credit markets are completely asleep.
Exactly. So today we are breaking down why capital isn't actually fleeing the market, it's really just migrating.
Correct. We've pulled three critical themes from today's proprietary updates that you need to be aware of.
First up, there is a severe momentum unwind, heavily concentrated in AI and semiconductors. And that is clashing directly with this massive broadening out into value and defensive sectors.
Second, we are seeing really resilient U.S. macro data paired with hawkish Federal Reserve commentary. And that's actively pushing back on these aggressive rate cut expectations.
Right. And third, we're tracking a striking divergence between extreme single-stock equity volatility and total calm in the credit markets.
Which really signals a healthy rotation rather than any sort of systemic risk.
Indeed. And to really grasp the magnitude of these equity moves, you have to anchor your analysis in the broader macroeconomic driver.
Right, and that driver is the sovereign bond market. Domestic and global interest rates have moved noticeably higher today.
Because the economic data simply refuses to crack.
Exactly. Just looking at the domestic curve in today's data deck, the U.S. 10-year Treasury yield drifted higher by 0.4 basis points, so it settled at 4.562%.
And meanwhile, the U.S. 2-year yield rose 0.6 basis points to 4.156%.
Yeah, and this upward pressure on yields isn't just isolated to the U.S. Global rates followed suit in a very synchronized way.
Right, UK gilts had a sharp sell-off. The 10-year yield spiked 4.5 basis points to 4.98%.
And German bunds rose 2.4 basis points as well.
Correct. And if we want to understand that move in yields, we really have to look directly at today's remarkably resilient economic data.
Initial jobless claims came in and significantly beat institutional consensus. They printed at 208,000, which is a 10-week low.
Yeah, and when you pair that labor market resilience with a retail sales control group, it paints a very clear picture.
Right, because that control group feeds directly into GDP calculations since it strips out volatile components like auto and gas.
Exactly, and that printed a solid positive 0.5%. So the narrative of some imminent economic slowdown just completely loses its foundation here.
Right. The consumer remains engaged and companies are clearly retaining their workers.
But let's pause right here for a second. Rates are high and the economy is running hot. How does that actually hit your portfolio as an investor?
That's the key question.
Right, so break this down to first principles for me. Why does a strong economy suddenly make certain stocks sell off?
Understood. So the clearest way to conceptualize this environment is to think of the risk-free interest rate as financial gravity.
Okay, financial gravity.
Yeah, this is what dealer desks call the hurdle rate. When you can earn a guaranteed yield of, over 4.5% on a risk-free government bond, that 4.5% becomes your baseline hurdle.
Right, a hurdle that every single other investment has to clear just to justify its inherent risk.
Correct. So when risk-free rates sit comfortably above that threshold and the underlying economy isn't breaking down, that financial gravity applied to high multiple growth stocks becomes extremely heavy.
Because those growth companies, they're priced based on massive earnings, projected 5, 10, or even 15 years into the future.
Exactly. Higher rates aggressively discount the present value of those distant cash flows.
So if that 4.5% is this heavy gravity pulling down the high-flying tech stocks, then the companies generating immediate tangible cash flow today are basically built closer to the ground.
Right. They don't have as far to fall. Investors just stop paying for promises of future dominance, and they start demanding present-day yield.
And we also have to factor in the hawkish Fed commentary we got today, which really reinforces this gravity.
Yeah, Dallas Fed President Lori Logan explicitly called for modestly higher rates, citing upside inflation risks.
And Kansas City Fed President Jeff Schmidt echoed that sentiment, emphasizing that inflation just remains too hot.
Which is why dealer desks are currently pricing a sub-coin flip chance, roughly 47% of a rate hike in September.
Right. The market is basically being forced to digest a higher for longer regime.
Moving to today's data, we can see that exact financial gravity pulling down the high beta equity complex. It's triggering a violent rotation.
Yeah, the market is structurally fracturing before our eyes. The high beta momentum index, ticker GSPRHIMO, has now plummeted 33% from its recent peak.
That is a severe unwind of the crowded AI trade.
Definitely. And the capitalization-weighted S&P 500, ticker SPX, dropped 51 basis points today.
While the tech-heavy NASDAQ 100, ticker NDX, fell 162 basis points.
However, beneath the surface of those headline declines, a massive broadening out is actually taking place.
Right. The equal-weight S&P 500, ticker RFP, notably outperformed the broader indices, closing 1% higher today.
On that point, it is crucial to note that this wasn't just some low-volume drift.
Not at all. This move in the equal weight index was supported by a massive $4.9 billion mark-on-close buy imbalance,
Which indicates severe institutional demand for the broader market, moving away from mega-cap tech.
Let me just jump in there to clarify that term for you listening.
Sure, go ahead.
A mark-on-close buy imbalance simply means that at the very end of the trading day, there is a massive wave of institutional purchase orders.
Right, $4.9 billion worth.
Exactly. And that completely overpowered the sell orders. It shows us exactly where the heavy institutional money is placing its bets as the closing bell rings.
Indeed. And the specific stock moves today perfectly illustrate this shift in capital allocation.
Just look at Taiwan's semiconductor manufacturing company, ticker TSM.
Yeah, they released an exceptional earnings report, beating institutional consensus with a record $706.6 billion new Taiwan dollar net profit.
They even raised their 2026 revenue guidance to over 40% year-over-year growth.
Yet despite those stellar numbers, the stock fell 2.3% today.
And the reason for that decline was a capital expenditure shock. TSM hiked their capex to a massive $60 to $64 billion.
Right, and while that's entirely necessary for building future capacity, it caused investors to immediately question the near-term return on investment for this sprawling AI infrastructure build-out.
Correct. That capex anxiety basically dragged the entire semiconductor index, ticker SOX, down 4.3%.
Similarly, Alphabet, ticker GOOGL, sank 4.4% today. And that was pressured by new regulatory and antitrust headwinds.
But the capital flowing out of semiconductors had to find a home.
Yeah, and our latest run shows exactly where it went. We saw a massive rotation into healthcare and defensive value.
Abbott Laboratories, ticker ABT, surged 12% following a strong earnings beat and an upward guidance revision.
Right, and that acted as a catalyst for the entire oversold medical technology sector.
We also saw United Health Group, ticker UNH, rally 7% on lower than expected medical costs and an upward revision to its 2026 earnings per share guidance.
And then there's Apple, ticker AAPL, which actually bucked the mega cap tech trend.
Yeah, rising 1.8% after securing approval for Apple Intelligence from China's Cyberspace Administration.
Which obviously opens up a critical revenue channel for them.
This rotation dynamic is playing out globally as well. There is a stark divergence in the Asian markets right now.
Right, the Kospi collapsed 6.37% today.
Because that index is heavily weighted towards semiconductor hardware manufacturers like SK Hynix and Samsung Electronics.
Right, the companies that basically bore the brunt of the TSM capex shock.
Conversely, the Hang Seng Index gained 1.33%. We tracked strong southbound inflows targeting Chinese AI application platforms.
So the software side of the trade, lifting names like Alibaba and Baidu?
Exactly.
Wait, I need to challenge this narrative right here, because this gets to the core of the market's current anxiety.
Okay, let's get into it.
Are we actually seeing a fundamental breakdown in the economics of artificial intelligence? Or is this simply an institutional rotation away from the hardware suppliers, the people making the picks and shovels, and moving toward the software and distribution networks?
Understood. And it is a critical distinction. Today's proprietary update suggests this is an institutional rotation based on where the durable profit margins will eventually settle, not some rejection of AI.
Right, because the initial phase of this bull market heavily rewarded the companies building the physical infrastructure.
The foundries, the server racks, the chip designers.
But as supply constraints ease and computing power eventually commoditizes, institutional capital is just front-running the next phase.
Correct. They are rotating into the toll booth providers.
The consumer platforms, the enterprise software companies, the healthcare distributors.
Right, the companies that will leverage that newly cheap computing power to drive their own margins. It is purely a rotation of positioning.
On that point, while equity markets process this transition, we really have to address an independent macro risk vector that is severely complicating the Fed's mandate right now.
Yeah, we are tracking persistent firmness in the energy complex.
Brent crude remains elevated, basically stalling in a sticky range around $84 to $87 per barrel.
Indeed. And this is not driven by demand metrics alone. It is heavily influenced by geopolitical supply shocks.
Right. Our daily desk data calculates that the ongoing closure of the Strait of Hormuz has removed an estimated 13.4 million barrels per day of crude oil from the global market.
To put that in perspective for you listening, that is a massive chunk of global daily consumption suddenly trapped.
And this supply constraint is keeping a firm floor under prices, which was directly reflected in the energy sector ETF, ticker XLE.
Which closed up 0.9% today.
The friction extends far beyond crude oil, though. European natural gas and refined products remain notably firm.
Right. Institutional positioning currently favors long TTF winter gas contracts.
And these positions basically act as a highly convex hedge against any further supply shock disruptions as we move toward the heating season.
Let me pause you there. A highly convex hedge is an institutional term, but for you managing your own risk, it basically means an investment with an asymmetric payoff.
Right. If European gas supplies get cut off again, the upside on these TTF contracts isn't just linear, it pays off exponentially.
Exactly. Institutions are buying these contracts not necessarily because they expect a crisis, but as cheap insurance in case a geopolitical shock hits energy grids this winter.
Moving to today's data, for you as an investor, this persistent risk premium in the energy complex matters deeply.
Because it makes the Federal Reserve's path back to a sustained 2% inflation target significantly harder.
Right. When energy costs remain stubbornly high due to geopolitical constraints rather than economic overheating, it bleeds into the cost of everything.
Transportation, manufacturing, consumer goods.
Which ties directly back to our earlier discussion on the hurdle rate. If energy keeps baseline inflation sticky, the Fed cannot easily justify aggressive rate cuts.
They have to maintain that heavy financial gravity on growth multiples to keep inflation in check.
Understood. So we really need to synthesize these simultaneous moves across rates, equities, and commodities to answer the ultimate question.
Right. What does this mean for the broader economic regime?
If you look solely at the tech sector, the price action feels highly disruptive. Single stock equity volatility has surged to the 99th percentile relative to 15-year histories.
Yeah, the momentum factor is experiencing historical dislocation.
However, when we overlay the credit markets onto today's data deck, the narrative completely changes.
Credit markets barely blink today. High-yield ETFs, specifically ticker HYG and ticker JNK, were virtually flat.
And more tellingly, the U.S. 5-year sovereign credit default swap actually tightened to 31.9 basis points.
Let's translate this, because the stability in credit is arguably the most important signal in our latest run.
Right. A credit default swap is essentially insurance against default. When that spread tightens, meaning it goes down to 31.9 basis points, it means the cost of buying insurance against a default is getting cheaper.
The market perceives less risk.
Exactly. If the sell-off in semiconductors and momentum stocks was actually a precursor to a systemic economic crisis, credit spreads would be blowing out.
Lenders would panic and price in mass default risk, but that is simply not happening.
Indeed. The debt markets are historically much more pragmatic than the equity markets.
Equity is the junior tranche. It absorbs all the emotional volatility of retail traders and momentum algorithms.
While debt holders really just care about underlying cash flows.
Furthermore, today's proprietary updates on global credit show zero evidence of a crowding out effect.
Right. Hyperscalers are issuing record amounts of debt to fund these $60 billion CapEx programs, yet the credit markets are easily digesting this supply.
And they are doing so without displacing private sector borrowers or forcing borrowing costs prohibitively higher for traditional industrials.
Capital remains abundant for fundamentally sound businesses.
Correct. The final verdict for you, digesting this data, is that the simultaneous moves we are tracking signal a healthy soft landing rotation.
Right. A violent tech sell-off, a robust equal weight rally, completely stable credit spreads, and firm commodities. It is not a systemic crisis.
Capital is not fleeing the market. It is simply migrating.
It's leaving overcrowded, high-multiple AI hardware names where near-term return on investment is being questioned.
And it is actively seeking out fundamentally sound, value-oriented sectors that have basically been ignored for the past year.
On that point, the mechanics of this market show a very healthy digestive process.
By punishing excessive capital expenditure in the short term, while simultaneously rewarding present-day cash flow in healthcare and industrials, the market is enforcing discipline.
I'll leave you with a final thought to consider as you position for the coming weeks. As this rotation accelerates, we are closely monitoring the risk of these newly favored sectors becoming overowned themselves.
Yeah, capital is flooding into contra-momentum trades, specifically regional banks and medical technology.
Right. So if institutional consensus continues to aggressively crowd into these value names just to hide from tech volatility, we have to ask a critical question.
At what point does the safe rotation trade become just as dangerously crowded as the AI momentum trade it replaced?
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week after a brief summer break with the latest market color. Good luck to Spain in the World Cup final, our pick from day one to win it all.